doing business in Africa. You can't afford to be without Africa Investor.
Well, good morning, everybody. Glad to see you're still in the room, and hopefully you can join us as we go through something which we think is slightly different from the average discussion as it relates to crowding in private capital and mobilizing private capital. I think we're going to place a lot of emphasis on the word scale. So I think I've already been able to illustrate scale, but just by the number of people that we have on our panel. But although I don't think that's the job done yet, because I think you're going to be more impressed with what they have to say than the constellation of them all set out there. So first of all, a very warm welcome to you to this particular panel on closing the emerging markets and developing countries investment gap. We're calling it a lab session as distinct from a sort of a normal panel discussion, because I sort of view each and every one of my esteemed colleagues here as scientists. They've been passionately experimenting, exploring solutions for the, problem of addressing this market failure of mobilizing private capital at scale for developing countries for a very long time, decades in some cases. So this lab arrangement is really designed to have them share the findings of all of their experience and expertise to put forward a number of very key and specific solutions and recommendations that ultimately will be shared with the COP28 presidency. I think we all may have a perspective on that. COP26 got the finance agenda, onto the, COP process. COP27 then doubled down on that, started talking a little bit more about multilateral development banks. And now we know that COP28 is really seeking to put finance front and center. And we think that this is going to be a contribution towards that thinking going forward. So we're going to address a number of different points. It's sort of broken up into two segments. The first one is really going to be looking at the fundamentals and the imperatives around addressing scale. And I think what we want to sort of move away from is this sort of discussion around developing countries and emerging markets and getting to scale. And then we then end up talking about these little micro approaches. And then when you conglomerate them all, we know that it's a very small piece of the overall agenda. So this panel and my esteemed scientists and reporters are going to address that. So we're going to be looking at private capital mobilization at scale strategies, the role of data and securitization, the infamous GEMS database. We're going to be talking very specifically about the bankable project pipeline. That's a $3 trillion nationally determined contribution project pipeline in Africa, or larger. It's a $23 trillion potential bankable pipeline for emerging markets, or larger. We're going to be addressing that. We're also going to be talking about the enabling investment climate and how hospitable the legal and regulatory frameworks and the procurement frameworks are to crowd in the participation of private capital and investment at scale. Then we're going to round off. We have three colleagues that are asset owners and from the asset owner community that are really going to, again, add their voice, talk about some of the really important things that they're doing and some of their perspectives about how to mobilize private capital at scale. So let me just quickly race you through who we have on this panel, and that'll probably leave us about 5 minutes to actually have a discussion. But that aside, we have Jared Glansbeek, who is the Executive Director and the Chief Investment Officer at Riskura. Don't feel shy to give a round of applause as I mention their names. I think you're going to find what they have to say very interesting. We have Jay Collins, who is the Vice Chairman of Banking and Capital Markets for Advisory at Citi. We have Mahesh Kochhar, who is the President of Structured Credit International Corporation. We have Guli Sabahi, who is the Senior Advisor on Climate Finance at the Nationally Determined Contributions Partnership, also known as NDC Partnerships. We have Pedro Galzo, who is the Chief Executive of the Investment Management of the UN Joint Staff Pension Fund. We have Eric Krypton, who is the Director for Business Relations at CDPQ Global. We have our Sovereign Wealth Fund Community Representative and CEO, Duncan Bonfield, who is the CEO of the International Forum of Sovereign Wealth Funds. And we are anticipating a colleague to join us shortly, Sonia Medina, who is the Executive Director for climate at the Children's Investment Fund. So to get us going, just beginning to look at this sort of the investment thesis component and the proof points and the fundamentals, I'm going to call on Jared to come in and just give us his perspectives on asset allocation at scale and just really talk to the performance-related issues. And I think the sort of point that we really are going to hear from Jared on is, something that we all know, that institutional allocations absolutely need to be exponentially increased for Africa's and the emerging markets and developing countries' $3 to $23 trillion investment gap or investment opportunity. So I suppose, it's really good to get your views on how can this be delivered. What is your pitch as an advisor to institutional investors about how this can be done and how this potential asset class can become a reliable and stable piece of asset owners' portfolios? So over to you, Jared.
Okay, thanks, Hubert. I think to start off, when you look at our clients, and there are two unique things about our client base. Like many people here, the clients are very large, and I think what's unique in terms of our client base, who we make these pitches to, is they are invested primarily in developing frontier and emerging markets. So these are people who have actually put money in, and they are institutions. And ultimately, when they're looking at strategies, they have liabilities which they need to meet, and as a consequence, that's really what they're investing for. So what I'd like to do then is just say that the challenges in that area, well, there's been one primary challenge over the last 15 years, and you've all had to deal with it. That's a strong dollar and a weak everything else. And so when all these institutions are contemplating investing, guess what they do? They look over their shoulder, and by the way, it's horrible, and they say, no, I'm not going there. Okay, so let me just talk about why these investors, these particular investors, have actually invested. So the first thing to note is, and I'm just going to use Africa as an example, if I may, because that's always the contentious continent. So if you look at Africa, what's been really interesting on the fixed interest side, and that's or fixed income, and that's a very broad category, actually the performance of that category, and that's quite an important difference between the way I would look at this and maybe some of my colleagues here, is that when you look at the portfolios, the beta has been so good. And if it's been diversified, the alpha, which has been choppy, the alpha being your extraordinary returns, can go either way. But if you have a diversified portfolio and you recognize that, let's say, risk can be priced, sold, avoided, or by the way, pooled. When you're pooling these things, you're getting rid of that risk. And when you look at that portfolio, it's actually done very well. And it's done extremely well. So that part of the African story has actually been very good. And it's easy to look over your shoulder and forwards, given how high yields are now, to actually say this is going to carry on doing well as long as you have a well-diversified portfolio. So I'm not going to worry about that. The second area where people are far more let's say, concerned is equity. And I just want to give you what has been positive for us in recognizing Africa in equity is we have, let's just say, a unlisted private equity portfolio, and so it's unlisted and it's across a variety of countries and companies. To the extent of about 150. So it's actually quite a diversified portfolio. What's interesting is if you look at the vintages going out 10 years, the earnings growth. Now remember, when you're running companies or you're looking at companies, and many people here are CFA charters, the earnings, and Benjamin Graham will tell you this, are really what drives company returns. So if you look at the earnings growth, what's really interesting there is over the last 10 years, the earnings growth on this specific portfolio is the same as the earnings growth on the NASDAQ, 10% odd in dollars. And by the way, and it matches the Russell 3000. You can actually just pull this off a Bloomberg. So you can go and look at the earnings yield, take out price, and just see what the growth is. So what's interesting there is then you would say, okay, well, the performance should be the same. And no, it hasn't. The NASDAQ has had a multiple which has shot through the roof. The Russell 3000 has had a multiple which has been pretty flat over that period. And Africa has gone down. So same kind of earnings stream, but when you look over your shoulder, no one wants to touch it, not because of the quality of the companies, but because of the multiples and the ratings. Now, here's where it gets interesting. Over the last 3 years, I'm just going to skip a whole lot of analysis, but over the last 3 years, the earnings growth of that portfolio has been 31%. It's a diversified portfolio, whereas the Russell and NASDAQ have been closer to the 10% level. But which one has outperformed? Okay, in this case, when you start to get to flat multiples, you start to actually see that the earnings growth is so high that the performance comes through. And that's what you're seeing. So you're seeing IRRs on that unlisted portfolio of 30%. Now, this doesn't sit comfortably with any of you on your view of Africa. Why? Because no one's close enough to the data that should be measured. But when you have the data and you look at the data, it's looking spectacularly. And those longer term assumptions really are where there's a problem. Now, in us pitching to these asset owners, and I'm sorry I'm going on a little bit, just one more point to make, is we have to look at their liabilities. So what you can do is it's just an actuarial assumption, or a whole lot of actuarial assumptions. And what you can do is you can so there's scheme rules and inflation. You build all this thing in and you get an 80-year cash flow stream. And what you can do is you can price that. So we then go and do that, and then we optimize that against all assets available in what's known as an asset liability model, which many of you will know. And it's based on market principles. So what that means is this is all forward-looking. When you look at that, and I just want you to know that when we put in Africa, and the same is true with emerging markets, et cetera, but just dealing with Africa, we hold a gun to the model's head in that the risk that we're using is 45%. Now, for those of you that know modeling, on a 12-month basis, that is pretty insane. It's pretty much like dealing with the gold market. When you do that, what's really interesting is people sometimes forget that portfolios are amazing things. You can take something high risk, add it to something low risk, take 2% of this and add it to this. And what happens to the risk of that new portfolio? It goes down. So when you do these calculations, it turns out that for very, very reasonable American members of pension funds, and by the way, pensioners, for a wide range of risks, you have this 1%, 2%, 3% of Africa creeping in. When you say, look, I'm not cared about risk, I just want return, then by the way, it kicks into Africa and it kicks into emerging markets and all other stuff. But if you just, on a model, and you look for from 0 to 15%, you have this thin sliver. Now, in terms of what you're saying, Hubert, is that 2% or 1% of all American portfolios, if in an optimal portfolio sense you put in Africa, I'm not sure we'd be having this discussion here right now. And so it's a really interesting thing, but people aren't doing the work. And the work is not being done because we all focus on the investment. But that's not really, you want the beta of the investment. You want to take out the excess risk. You hire very good specialists to do that. You use blended finance. All of these things are really good tricks as long as you get a diversified portfolio, because then it actually comes through quite nicely. And that's the important thing, is to look realistically backwards and see what's actually happening, and then make sure that you're pooling in your portfolios to get the right risk dynamics within a total portfolio framework as opposed to one asset.
Okay, now thank you very much, Jared. I think that's very clear. Just for the record, we do want to retire this conversation and really start focusing on actually executing against this scale. And I think that's where I'm going to come to. I'm going to come to Jay now, because when we talk about private capital mobilization at scale, it's still extraordinary to me, at least, that when we're talking about mobilizing these trillions, we're actually, and then these trillions of private capital in many respects, we're actually letting the public sector drive the bus. So private capital mobilization is essentially a domain that's actually led in many respects, at least at the catalytic level, by the multilateral development bank conversation. And when you begin to look at the private capital mobilization ratios in terms of the level of success that the public sector, the MDBs, have had at mobilizing private capital at scale, for every $1 that they finance, they're supposed to be able to mobilize $10 of private finance. And the actual record, as reported by G20 and others, is that for every $1 that they provide, they've only been able to mobilize between 20 and 38 cents. So that's obviously a track record from the public sector about how to mobilize private capital at scale. So I'm going to come to you now, Jay, and see if perhaps you might be able to give us some ideas about how we can improve upon that mobilization ratio and give, what are some of the success factors that private capital has been able to create at scale market opportunities, and how could that be applied and accelerated for emerging markets and developing countries. So over to you.
Even the question
Small
was
task.
a mouthful.
Yes.
Okay, so first of all, if I may, I just want to add to what you said about the power of pooling and diversification, because dynamically managed portfolios that are diversified. We went back to this after the financial crisis. That works, and it's a very powerful concept, because when we look at the dramatic need for equity risk as kind of a starting layer, or any risk, diversification helps. Pooled diversification helps. It helps with debt, it helps with equity, and we're going to have a big meeting in a couple hours of the NDC where we're focused on what came out of the Macron summit on FX. Same concept. If you give me a basket of currencies and you want to actually lower the carry, the cost of hedging, if I basketize or pool, I can reduce risk. So this is a tool that's important when you ask that question of scale, because it is a tool in the toolkit, so to speak, that's critical. But one of the ways you've got to get there conceptually, right, is you have to have a vehicle, a facility, or a program above the head of individual projects, right? And that's something that we just haven't seen done. I mentioned in the last session that one of the reasons that we're not blending at scale is that we don't have enough projects. But conceptually, if you could raise billions of dollars of funds above the project level, there are a lot of risk management techniques available out there that we could use even in the private sector. For example, many of you may not know that I have called for, I said 1,000 times, but 100 times, whatever it is, that we need 1,000 times the power of MIGA. That if we're really going to do this, we need to guarantee at scale. And we're not doing that. But do you know that MIGA puts 70% of its risk into the insurance industry in private capital markets? So one thing that we at Citi have looked at, and we did this as advisor to the COVAX facility on vaccines, because COVAX took risk, as you may know, to, on one side, negotiate and purchase vaccines from all the vaccine manufacturers in order to get them to the emerging markets countries. And it was an NGO, right, that had all that risk. So we said, well, wait a minute, you can't just carry that risk. What if some of these EM countries that are supposed to take the vaccines can't pay? We actually went to a consortium of insurance companies that were able to give us a price at speed to insure that side. And I think there's a lot of examples of how we can be much more efficient with allocation of risk. It's interesting, risk has to be placed to where it's held best. And a lot of times the world tries to force the wrong risk into someone who can't take that risk. And if you look up and down the capital stack, I think you're going to speak a little bit about sovereign wealth funds, right? But so sovereign wealth funds can actually take a different kind of risk, and you'll talk about it, but they're very unique in their long duration perspective that someone who's marking to market every day can't take, right? There are insurance companies that quite frankly, you go to the third floor and you sit down and you talk to the the developed world team about infrastructure, green infrastructure. And they understand infrastructure and can take long duration project risk. But when you say, let's talk about single B, let's talk about Africa, they're no, go to the 7th floor. Go talk to them. So you go up to the 7th floor and you sit down with the EM team and you talk to them. Well, fine until you say, but wait a minute, this is project finance risk. They're like, no, go back down to 3. So we have a lot of things that go beyond the MDBs in terms of how we can be smarter and faster if we're going to scale the ability to take risk. And we have great new players. We have all these climate funds that have entered into the world. We have philanthropic money to bolt to the ODA problem I mentioned earlier, that there's philanthropic money that will actually step in and catalyze a debt for sustainability swap, or actually put a grant in to get projects developed faster. And then finally, again, I've tried to stay away from MDBs because I want people to conceptualize that MDBs are the gorilla in the room of a reform effort to get them to mobilize more and take risk differently, structure products that mitigate our risk. But there are other tools out there. And one of the things I tell ministers around the world every day is you have this project, and let's just say it's hydrogen. And you're conceptualizing and you're sitting down with all these MDBs and the green NGO community, et cetera. But have you actually talked to the top 5 players, global sponsors of large corporates, and asked them to come help develop that project for you in the country? Have them do the feasibility study. Why isn't that happening? Because at the end of the day, those global players take equity risk. They can figure out how to finance it, not on your balance sheet as a government. And they may actually, if you meet them halfway in terms of the enabling environment, they'll actually do the feasibility study for you. So why aren't you talking to the private sector aggressively and proactively about that? And I'll stop there.
No, thank you very much, Jay. I think you've raised a number of points that colleagues are going to come back and share their views on. I mean, just when you talk about the scale of the de-risking and the insurance market, I mean, if you look at, I mean, on average, I mean, it was a broad statement though, but, if you look at an average financing, whether we're looking at the pool of 3 to 23 trillion, approximately a third would require some form of de-risking instrument. So if you look in the African context of a 3 trillion, that's potentially a trillion, of which people are now beginning to enumerate that could be a 500 billion to a 750 billion de-risking financing opportunity. And then when you begin to look at the capacity in the market, whether it's the African Trade Insurance Agency as capacity, that's a $400 million balance sheet. Everything it touches gets reinsured, and it's got a backstop from the World Bank. So that's not really a natural market instrument. And then people say, well, no, well, let's really look at MIGA. But the Multilateral Investment Guarantee Agency, again, is a $60 billion balance sheet, and we're talking about half a trillion to 750 billion. So I think there are real market opportunities if we can just allocate that risk. But to do that, we absolutely need the right type of data, because without the right level of data, we're always going to presume that the risk is higher than perhaps it is, unless it can be evidenced. So that just takes me neatly on to Mahesh, because every time we talk about data and being able to have some kind of insight-driven approach to how to allocate to emerging markets and developing countries, this acronym comes up: GEMS, Global Emerging Markets Database, that risk database that's become proprietary to the multilateral development banks. And we know that there's a GEMS 2.0 project where it's going to be hived out and sort of run as a separate, well, it's going to be democratized to some extent, but we in the investment community feel that it should actually be built out so that there are better sets of data. So it's not just a reference tool, but it becomes an asset allocation at scale tool. But I suppose your job is to talk about that, so over to you.
Thanks for
Microphone.
The panel here with such a distinguished.
Oh.
Is this on? Yeah, it's working. Thank you. So, scale is a beautiful thing. Pooling has been mentioned. Diversification has been mentioned. Those are sort of the magic potions. A principle of scale is a greater disclosure of repayment record catalyzes lending. The disclosure of delinquency and loss data, such as is available at the GEMS database, is critical for scale in climate finance, as frankly in any kind of finance. Similar borrower loan performance data was critical in the buildup of the asset-backed and mortgage-backed securities markets to multiple trillions of dollars. To realize this potential, we must encourage professionalization, disclosure, and use of the GEMS database, which is actually run by a couple of dozen DFIs, development banks like EIB and IFC. But a bit like donkey the manger, they are sitting on it and won't let the rest of us see it. I mean, it's overdrawing it a little bit. They are now beginning to divulge it. But the process that they have is still bureaucratic and needs to be accelerated. AU, not to be outdone, has proposed a model law for its member states to put in the rule of law and improve the business environment and to mobilize scale if it were put in. We were able to catalyze it. And if the asset allocations to Africa, as Jared said, can rise from 1% or thereabouts to 5%, which is the goal of the AU, that could make a huge difference in scale. The AU has also proposed that the investors be granted what's called preferred investor status, which doesn't exist, but it could be put in place, cloning what does happen for MDBs, which is PCS, preferred creditor status, which is by practice, not by law. If this can be done without loss of AAA ratings of the MDBs, it would actually help elicit some investors into the market if they have some preferential repayment possibilities. Now, what is data good for? I used to be at Standard & Poor's many years ago, running their international ratings, including structured finance ratings. Well, data goes into the pot, and you store it, and you come out with rating criteria. What are rating criteria? Criteria are the standards in structured finance whereby you set the rules which must be met in order to achieve investment grade ratings. Jay talked about investment grade ratings and how their critical role in eliciting volumes of investment in the earlier panel that I happened to sit in on. Now, those investment grade ratings are determined based on stress tests, but in must come data. There are gobs and gobs of data, sliced and diced every which way about every country, about every sector, about every kind of project going back eons, right? The database in the GEMS system has been collected over 15 years. It's got 33 years of data. The S&P and Moody's and Fitch have data going back 70 years, 70 years, okay? The more data, the better. And you can structure from that asset-backed securities, mortgage-backed securities, you can structure infrastructure-backed financings, you can structure climate financings, anything that moves, all right? But you need data, and we must have data coming in from GEMS to the market, without which we cannot really step forward and do this kind of work in volume without the use of MDBs to the same extent that we keep talking about from time to time. Now, let me show you what can be done. African Development Bank in 2019 relied on only its internal data to come up with a deal to securitize 50 loans totaling $1 billion, pooling, right? Pooling and diversification and scale, $1 billion. Okay, but they had to put up 27.25% of protection under the senior tranches to get the senior tranche to be investment grade. Basic, call it 4-to-1 leverage. If the data had been there from the markets, that ratio could have been increased to 4-5 times or even more. So data buys you greater confidence in the potential for recovery of your investment down the road. That's what we need from GEMS. GEMS database has it has some benefits, so I want to give them credit for having done it. But it has some serious limitations. It is non-public, even for the rating agencies, and the data collection and distribution processes are very bureaucratic. The data, I mean, somebody told me that he sent an inquiry and it took 6 months to get a response because the guy that was going to respond had an accident. So that's not workable. That has to change. It has to be institutionalized. And so to do that, it has to be put on an independent footing and professionalized. A great challenge in climate finance is also for better project development, which Jay has talked about. You can't really securitize or fund unless you have a project. But I'm optimistic on that because $1 trillion green bond market has developed in just a dozen years. So why not? Now we have blue bonds from Seychelles, Barbados, Belize, Ecuador, and most recently Gabon. So these can also be scaled up. The Nature Conservancy is overseeing Gabon and Ecuador transactions and can do many more. So I'm optimistic. Now, credit enhancement is key because there has to be quality credit for those who want quality, and other investors are willing to take risks, so you can segment and then get to the blended finance. Guarantors like, of course, DFC have played in the blue bond market. Others are coming in, like the Green Guarantee Company, and many others from the private sector may also join over time. So as in the structured finance markets, I think initially there was reliance on monolines and bank guarantees, but gradually senior subordinated structures came along, and investor segmentation allowed those who wanted yield to take the lower tranches and those who wanted lower risk and higher quality to take the senior tranches. And of course, cash collateral came in too. So cash from the non-NGO and the Bill Gates of the world and the philanthropies can come in and play a role too. The next step is to go from GEMS 2.0, which is going to give you a little bit of a disclosure, to really a full-blown GEMS 3.0, where you have global institutional investors and rating agencies and others can get access to well-managed, well-constructed, easy-to-access, reliable data on performance in projects and structures over time. So it should complement, expand, and broaden the development of the data sets to mobilize private resources and work with the rating agencies to develop criteria for climate finance transactions. It should analyze the data to provide global institutional investors with the wherewithal to rely on investing with confidence. And it should help enhance asset allocations. All of this can happen if data is available. Larry Fink, who founded, I almost worked with him, I should have. He founded BlackRock, which has $10 trillion in assets. Now he predicted that this market could scale up if we had the following things. First, lost by the countries. Second, lost by MDBs. And then he would come in. But I think that's the first stage of the market. Then come cash collateral, then come senior subordinated transactions, and that's when the market will really scale up. Thank you.
No, thank you very much, Mahesh. I think that's very clear. And the GEMS 3.0 project is definitely one that is being championed by colleagues here at the CFA Asset Owners Council. We think it's going to be a very valuable and transformative project. I mean, just the last two releases, the sort of restricted releases of data from the GEMS database, when analyzed, drew the conclusion that emerging market and developing country governments, by not having access to that database, on average, are probably paying about $15.6 billion a year in excess interest payments on loans. So we think that that's a powerful and useful exercise for the CFA Asset Owners Council. But I think another powerful and useful exercise is to actually have some underlying projects to be able to invest in, which takes us to Guli. who is going to tell us all about the nationally determined contribution projects, the projects that governments have made commitments to, the ones that are always announced during the UNFCCC process and at the big COP summits, last year in Sharm el-Sheikh, this year in Dubai. And we see that as a great opportunity set, a great pool of transactions that NDC Partnership are making bankable. I suppose from the investment community, we also believe that we have the expertise that daily, as our day job, sort of designs projects, finances projects, operates projects, maintains projects. That could be a really good contribution towards the work of the NDC Partnership and others. But let me pass over to you, Guli, to share your views on the investability and the actions towards making that pool of projects an at-scale investment opportunity. Over to you.
Thank you very much, Hubert. Maybe before I share my remarks, just a quick introduction about the NDC Partnership for those of you who are not familiar. NDC Partnership is a global coalition that has over 200 members, including more than 100 developing countries and developed nations, as well as MDBs and UN agencies and other key stakeholders like IRENA, WRI, or CPI, and many others. So the purpose of the partnership, really, the reason it was set up, of course, to help countries enhance NDCs, but a lot of our work right now focuses on implementation of NDCs, which is a very complex and broad process that essentially helps countries to take their NDC targets and translate them into investment actions. So we support countries in developing what we call NDC implementation plans. And ideally, those implementation plans have to identify sectoral priorities and investment needs and lead to the generation and the creation of the project pipeline. We work with the Ministries of Finance and Ministries of Environment. Those are our focal points. There is a lot of, as you can imagine, requests that are coming out from countries about all sorts of climate, finance-related requests. A lot of the requests relate to investment planning work, as well as project development work, and many other requests. So what we have been trying to do, to create that pipeline of projects, first of all, support countries in undertaking a cohesive NDC investment planning process. Because when we talk to the investors, they highlight the importance of a proper kind of transparent and disciplined process across the economy being undertaken by countries in prioritizing projects so that they withstand political cycles and they deliver both development and climate impact. So I think while we do this work on investment planning and creation of pipeline of projects, I wanted to just note three things, in terms of our private sector engagement, which is a key part of our work. Number one, I think countries need to understand the entire value chain because they ask us often to do the mapping of private sector. And the private sector, it's a value chain. You start all the way with your institutional investors, and there are different types. They're publicly owned institutional investors like sovereign wealth funds that Duncan is going to talk about. They're privately owned institutional investors. They also have, different mandates, different risk tolerance. But then you also have corporates that have a vested interest in greening their supply chain that may be able to take more of that equity risk that Jay has talked about and may be able to come in and do more of the project development work. Then you have the whole, supply chain. So I think it's very important for the countries to understand the value chain, and when they do their investment planning and create their pipeline of projects, they really distinguish between the projects that would attract different type of investors and different type of products. And also pooling arrangements are important because, you have in that pile of NDC projects, you have some, high return projects, you have low return projects, you have high risk projects, low risk projects, you have adaptation, mitigation, hybrid projects. So it's important for the countries to understand how they need to be categorizing the projects and what projects would qualify for what. For example, blended finance, we have been saying that, it needs to scale, it needs a pipeline of projects, but what projects would qualify for blended finance? Those have to be the projects that don't yet have an established business case, but have a potential of commercial viability. So it's very important, I think, to support countries in that process. I also wanted to really commend you, Hubert, and the team for putting forward that model law on institutional investor and public partnerships, because that's type of private sector input that is needed as we support countries in developing enabling environment, really understanding how can the processes of identification, prioritization, procurement and development could be streamlined and supported by the private sector. So I will stop here and happy to chime in later on.
Thank you very much, Guli, and we thank you for your partnership as well. I think it's taken a while for governments to appreciate how willing we are to help them sort of alleviate this project preparation burden. Because we do that in the private sector, the companies are doing that, developing projects, and I think through that type of partnership, we can really accelerate the pipeline to get to the scale that we need. And talking about the scale that we need, I'm just going to close out now with our last three asset owner speakers who are really going to share how the industry is coming together. Again, we talk about the multilateral development bank sort of community. Well, that's a collective $1.5 trillion balance sheet when you conglomerate them all. But now when you start looking at asset owners, the sort of the bigger, broader institutional market, that's between 150 trillion. So just by its very existence, its scale. So this part of the conversation is really just going to hear some perspectives from three esteemed colleagues, just about how the industry is positioning itself to really provide leadership. And it's an extrapolation. I think we just want to make this little point of distinction. The global financial architecture conversation is a very important one, and that reform agenda is critical. But within that overall agenda, there is this private capital mobilization piece, which I think is the piece that the asset owner community have identified, that if you really want to mobilize public sector capital, if you want to mobilize public capital at scale, it's probably not best to speak to the private sector about it. So you'd ask the public sector to address that. So if you're talking about mobilizing private capital at scale, it's really asset owners, institutional long-term investors that are best placed to provide input, leadership, and guidance on that. So I'm now going to turn to you, Pedro, to just give your views, as the UN Joint Staff Pension Fund, and of course working across, on a horizontal basis, lots of asset owner groups, about how you believe the asset owner community are and can provide more leadership to close the investment gap at scale in emerging markets and developing countries. Over to you.
Thank you. And everything that you have said, guys, is very useful, and I will try to incorporate I will give you in 3 minutes the one day in the life of an asset owner, right? And
only 3 minutes?
3 minutes. Very brief. And correct me later, guys, if you want to add anything. First, who are we, not the asset owners? It's institutional investors, pension funds, insurance companies, sovereign funds, and endowments. But that's basically what is called asset owners. And we are mostly public or public-like, right? Which is very important to hear. Now, how do we work? We, going back to models, every once in a while, 3 years, 4 years, 5 years, depending on your business model, but we do an asset allocation study. And we hire the usual suspects. It could be Ortec, it could be Aon, it could be those organizations that help us, and we all hire the same ones, the 4 or 5 ones. And those guys, based on benchmarks, generated basically from two of your sponsors here, MSCI, S&P, Bloomberg. Based on those benchmarks, they recommend the best asset allocation that will generate the best risk-adjusted rate of return in the next 30 years. So that's what we do. And then with that, it says you can invest only 1% into emerging markets debt and probably 5% in public equity in emerging markets. And on private markets, they don't even say that, right? But they give you, follow this benchmark and follow that. So, and I'm pointing out here players, right? Players that if we want to get to size and scale, those players are important because, again, those guys, those 4 or 5 Aons, Ortex, all those guys are determining the asset allocation of most of us, following the benchmarks of those 3 or 4 companies that are creating the benchmarks. And now we go and implement, right? And we have different business models, but we basically are benchmark hoggers, right? Because remember, we are, and we like to pretend that we are active managers, right? But we take very simple bets around the benchmark, right? So again, the benchmark has very small allocation to emerging markets. Why? Because our staff, going back to we're public civil servants, most of us, we are not incentivized to deviate further away from the benchmark, right? So all the system is generating a behavior. And then when it comes to private markets, again, we are benchmarking ourselves to a benchmark that has a very small allocation. And then we have very small teams, all of us, very small teams. And then you have to deploy, let's say, $1.5 billion a year on private equity, right? And you can do it in 4 or 5 transactions, no, at a ticket size of $250 million. Or you can do it in 20 different deals that will take you 20 times the amount of time and 20 times the amount of effort and due diligence. No? Guess which one they would do, right? So, and we get bombarded by all the large GPs offering billions of dollars of funds, and you can fill your allocation in 5 deals, or being bombarded by hundreds of smaller GPs that don't follow into our rules, because what we, in the rules for selecting GPs, we say 3 years of experience and good performance and the team that has been there forever and the founders and the this and the that and the that. So the whole system is skewed for size, for scale. And we're not seeing that happening. No, you have explained why. You know? There are no projects. There is a lot of capital ready from all of us. You said the number, 1 point something trillions of dollars. We all want to be sustainable. We all want to invest in this type of projects, but looks like there are not many projects, no, or they are being generated on the pipeline, but they are not there. And second, they're not being brought to us in a scale enough so that we can even process and think about investing on them. We cannot invest in funds that are less than $1 billion, right? Because, and we will ask the other asset owners, but my private markets team, they wouldn't pick up the phone for a ticket that is less than $150, $200 million, right? So that, and we cannot invest more than 20% on a particular fund. So that makes it funds larger than $1 billion. So you have to have a lot of projects that are vetted and that you have already structured that are attractive and we can invest in them. So what I would propose as an idea is we have to work on those actuaries, no, the Aons, the Ortex, to change their models. Second, we have to speak with the benchmark with the benchmark providers, the MSCI, the S&Ps, the Bloombergs, all those guys, because there should be space to do it, right? You were talking about the blue bonds and all those guys. They are not in the benchmark. So something has to happen. They have to be included in the benchmark. They have to create a space so that our investment officers on the day-to-day, they want to invest there. And then something has to happen in the private markets sphere. There cannot be so many, right? There's no space for hundreds and hundreds of GPs that are just fragmenting and not channeling the capital that it's available from us that should get to the place. And then, of course, there have to be projects that are bankable and attractive to all of us. So I hope that it helps.
No, very helpful. I think we've all got our work cut out. I think the market's got its work cut out. But I think it's changing and it's evolving fast. If you look at, I don't know, the continent and mobilizing, climate finance and private finance, gone are the days when we can turn around and say, show me just a pipeline of projects. And then we can think about making an allocation against that. We're now looking at a situation where we're saying, okay, show me how investing in your portfolio of opportunities is better than investing through the Inflation Reduction Act or investing through the Net Zero Industry Act. In other words, there needs to be a high degree of incentivization for the asset allocation decision. So I think absolutely we've all got our work cut out. And now let me quickly move to Eric from CDPQ.
Thank you, Herbert. I'm going to focus my remarks on a slightly different aspect of risk than we're used to speaking of. So all of us so far have mostly spoken about the financial risk elements and the challenges for private capital mobilization. But there's another set that is equally important, and these are the non-financial risks. So for us as a pension fund, if we want to invest in emerging markets, Africa or wherever, assuming we get all the technical stuff right, we get the de-risking capital, we figure out how we're gonna manage our FX risk. There's a pipeline, we have the data. We'll still need to go to the investment committees, the representatives of the depositors, and win their approval. And they're gonna ask us about things that have nothing to do with the financial elements because they're gonna assume that those are taken care of or we would never even be there in the first place. They're gonna ask us, well, how are you protecting against reputational risk and political risk? And these other non-financial risk elements, and it can kind of be summed up as a simple question. If something goes wrong, who are you going to call? You don't know these markets. These aren't your home markets. You've never been there before. How are you going to fix a problem if one emerges? Because no matter where you invest, whether it's in Montreal, in Manhattan, or Mozambique, things go wrong, right? If things didn't go wrong, there'd be no risk and there'd be no return. And so they're often interested in knowing what's your plan for solving these problems. And it's a challenge, to be honest, because for most of us pension funds, we don't have long-standing institutional relationships with either the governments or the private sector in a lot of these countries. And so that right there is the issue. So how do we go about trying to solve that? So let me draw on SDG 17 and the word partnerships, because I think that's the way to go. And I'll look at 3 or 4 kinds of partnerships. One is with the governments themselves. So I really think, and you were asking in the note, recommendations for heads of state. I think one is it'll be very important for the governments of emerging economies to do more, and conversely for the institutional investors to do more to try and build direct relations with each other so that they become familiar with each other, learn each other's language, vocabulary, priorities, and build that trust that is needed over time to feel confident to deploy capital at scale. So that's one. Other kinds of partnerships. I know we're not really supposed to talk about the MDBs, but I will a little bit. The multilateral development banks have presence in every one of these countries, and they often have very well-connected resident coordinators who have good government relations. But it's not just the MDBs, the UN too, for that matter, right? The UN have resident coordinators. So getting them involved, they might not always be able to provide financing, and the UN essentially never, but they can help provide, political risk mitigation. If I can tell my depositors or my investment committee, yes, the UN has skin in the game. If something goes wrong, I do have a 911 I can call. I can call the UN resident coordinator in country XYZ, and he or she's on the case and will do the best they can to resolve this issue. That will go a long way. And then there's partnerships amongst us, the investors themselves. So again, if I'm presenting, it will help if I can say, hey, we're investing with Citibank. We're investing with these big institutions. That will give, the representatives of, Quebec firefighters confidence that, we're not messing around. We're going in with serious players who know what they're doing. So that kind of partnership and find, partnerships with the donor governments. It will also help if I'm able to say, oh, we're not just investing by ourselves. We're investing with, Uncle Sam, the US government. We're investing with Japan, with the UK. All of that will help overcome what's essentially almost psychological barriers to wanting to deploy money to markets that people are unfamiliar with. And I think that's an important element of these conversations. Thank you.
Fantastic. No, absolutely, an extremely important element of these conversations, and we would absolutely, and we do applaud the work of the African Green Infrastructure Investment Bank, because that's anchored on the premise of giving you a talking point, for example, to be able to go back to your depositors in those investment committee meetings and saying that we are also investing with the local institutional investors on aligned terms in the market, which gives you that sort of skin in the game from the local market, but it also gives you that quasi co-investment linkage into the government. So absolutely, there's another talking point there, and that's actually happening in practice. So that's wonderful. So let's just close out with a representative that sort of talks to that same constituency, the local sovereign funds who are that perfect partner in these types of situations, subject to alignment being established through institutional investor-public partnership. So over to you to close us out, Duncan.
Okay, and I'll just take really just 2 minutes to say a couple of things. And the firstly is to emphasize a point that's been made about risk. This is all about getting the appropriate return for the risk that you take. Now, sovereign wealth funds are long-term, or they're savings funds, they're long-terms, they're contrarian, they're patient capital, and they can accept illiquidity. I was talking to a fund the other day. It hasn't got its first payout until 2080. That's its time horizon for liquidity. So it can take that on long-term illiquidity in an investment at the appropriate rate. But then and that's a clear point about risk. That has to come down, and I think it was Jared mentioned risk and 40% in terms of a plan, and that's the result that you get. But all actors need to be aware of that. So one of the ways to address that is a number of sovereign wealth funds actually have skin in the game in their domestic markets. They're called strategic funds. Now they recently met in Africa and Rwanda. And what they're trying to do is actually at scale is put together, and there are other institutions like Hubert's Green Infrastructure Investment, but they're trying to put together those projects at scale and de-risk them at a governmental level by having a government-sponsored fund that's actually involved. So that way takes out some of that broad political risk. And of course, they're populated by people like yourselves who've got experience of markets and what's required. So that is going on. So there is active work. And the point of that, there's a good example of this in India. NIIF established a fund. The Indian government invested in it. It established a proper portfolio of investment. It established a whole private equity approach, and that's actually owned by 2 sovereign wealth funds, or at least in part, ADIA and GIC. So there are good examples that work. And then the final point I'd make is really to people in this room as much as anyone else. Somebody mentioned the green bond market reaching a certain amount. Now, it's clear that there's demand from investors for these kind of investments. However, if in that market there is greenwashing and they're not real investments, A, it takes money away that could potentially be invested in developing markets, and B, it sours the reputation for everybody in terms of that. So my plea to you would be make sure you keep a strong eye on that and take a stand if you see something that you don't think is appropriate.
Doing business in Africa, you can't afford to be without Africa Investor.